Welcome everyone to Daily Rates Live with the Mortgage Calculator. We will wait just a couple of minutes to get started here. Let everybody get a chance to hop on. Feel free to drop a comment there in the chat as you tune in. Thank you already, people tuning in and dropping comments. Appreciate that. We put the chat up on the screen so you can drop comments there. All right. Thank you for the comments, Harriet, Owen, Sandra, Nicole, Dario. Appreciate the comments as you're tuning in. We'll wait just another minute here to let everybody have a chance to tune in and go live on all the different platforms. We are streaming this live on YouTube, Facebook, and LinkedIn. All right, it looks like we are good to go. So we'll go ahead and take the chat off the screen and we can get started here. All right, welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. What we do on this show every weekday is go through the live mortgage rates for different programs, and then we do a deep dive into a different topic every day. Now, we are a correspondent lender that specializes in non-QM loans, and today's topic is one of our specialties when it comes to non-QM loans, our favorite loan, which is DSCR loans, debt service coverage ratio. That is our loan for investors for investment properties that do not require any income verification or job verification. It is simply based off the gross market rent of the property. So our sales manager, Jose Gonzalez, with 27 years of experience, is going to do a full deep dive breakdown into DSCR loans here shortly. But before we do that, we'll do what we do every morning, which is have Nick pull up our pricing tool and go through the live mortgage rates for today. So Nick, let's go ahead and pull up the pricing tool and let's see what the market is looking like this morning.
Alrighty, let me switch my screen and we will check it out. So this screen is our pricing tool for our team. This will show us the general rates and APR for today. It is August 18th, just after 11 a.m. So all our standard programs are live with new rates. If you'd like a full breakdown, a full loan estimate with all the fees itemized, please reach out to one of our team members. We have over 300 loan officers in 24 states for primary and second homes, and we can do our DSCR loans topic for today in 44 states, almost all the country. So for today, to compare some programs, we will set up a basic scenario so we can compare across all the different programs. 400,000 loan amount. We'll set all of our demos today to 80 LTV, 20% down payment. We will set the desired price to 99. That means we'll ask the computer to find the best rate at one discount point in cost. And we'll compare our programs. We'll start with conforming conventional as we do every day. Then we'll check out the FHA rates this morning. And then we'll go into expanded guidelines, also known as non-QM, where we have over 5,000 additional options using alternative income. We also have VA and USDA. Remember, VA is only for our eligible veterans and active service members. If you are eligible, let us know. We can quote it. And USDA is only for eligible properties. If you do happen to be shopping in a rural USDA area, let us know. We can quote that, no problem. We'll start today with conforming conventional. We'll do purchase, 30-year fixed. Primary occupancy, single family home, 1 unit, state of Florida, county and Miami-Dade. And for all the demos, we use an estimated FICO score 760 and an estimated debt to income ratio here of 40%. So with those settings, like we do every morning, let's check the basic rates. So still about the same as it was yesterday, definitely up, highest in quite some time here, 20 years or so, 7.49 rate. 0.875 discount points at cost. Final APR puts us at 7.652. So again, hopefully we see some downward momentum finally, and this is the peak here. Now, if our customer doesn't qualify for conforming for any reason, typically the next option is FHA. So we'll set up the same exact scenario so we can compare a conventional example to FHA. Everything else will stay exactly the same. Now, FHA does allow a little bit more leniency on credit events as well as a higher debt to income ratio. So this is typically the next option if our customer has any trouble. The rate here, 6.75, 0.875 discount points, final APR 7.338. So both FHA and conventional are higher than they have been previously, but as always, FHA is a touch cheaper in this case. So if our customer qualifies for both, definitely recommend to check out FHA. It could actually be cheaper, even though it does include both yearly and upfront mortgage insurance. Now, if our customer doesn't qualify for conventional or FHA, many other banks or lenders don't have other options, but that's where we specialize here. So, if any customer can't qualify for the standard programs, we will go to our expanded guidelines, also known as non-QM, where we can use alternative income. So now we have a new option pop up here, income verification. Full doc is the default option. That's what we use for conventional and FHA. That's 2 years of tax returns. So we would typically choose a non-QM option to take advantage of one of the alternates, such as asset-related programs we've done a couple episodes on. Business bank statement programs are popular. Our DSCR options for investment properties we'll talk about here in a minute. Personal bank statement 12-month is the most popular one by far. So that's the one we choose for a primary home. We also have RSU, stated income, VOE, 1099, P&L, and no income CDFI. So tons of different options here. The one we always do our demo for, the most popular, is the 12-month personal bank statement program, and that's for our self-employed borrowers. Anytime our self-employed borrowers, when they submit tax returns, will have write-offs and may have a hard time qualifying at all, or may just not quite get as much income as they need to qualify for the home they really want. So in this case, we'll use a non-QM program using just their last 12 bank statements to solve that problem. And we will determine a debt to income ratio here of 40% in this example, using no tax returns involved and just using the cash on the bank statements. So most of our self-employed borrowers will qualify for double or triple the income using this method and can therefore get the home they really want. So let's check out the non-QM options this morning. And it's an amazing thing, again, when we have some non-QM options that are right at or less than the cost of a conventional option, which here we have a 7.5 rate for 1.75 discount points of cost. So there's always a little bit more cost typically with non-QM, but still puts our final APR at 7.592. I believe that's identical to what it was in conventional. I can't recall the exact number, but it's right there with conventional today. Definitely some good options. Some of the more standard bank statement options here, a little bit higher rates, may allow some other leniency on other items such as credit events, foreclosures, bankruptcies, and other things. So not only can we solve our income problem for our borrowers, we can also typically solve any other qualification issues by using one of these non-QM programs. Now, we always do our live pricing for investment properties. So for our final couple of demos, we'll set up the same scenario, 80% loan to value, 20% down payment, and we'll go over some investment property options. We will compare our conforming conventional with our non-QM options. Remember, the government programs, FHA, VA, and USDA, do not work for investments. So we'll start with conforming conventional. Everything else will stay exactly the same. All we've edited here is investment. So this will show us what adjustments the conventional programs have added for investment properties. And here's the best option here, 7.5 rate, but seriously crazy discount points here, 4.5 discount points, which would obviously probably not be legal to do. So definitely would have to try to work this into something different. Final APR here, 7.783. So these costs for these investment properties under conventional have become very prohibitive. Because we can't go to a higher rate in order to reduce the discount points. The computer was not able to find a higher rate option at more like a 1 discount point option. And most investors anyway, in this case, would not like to spend $18,000 in fees in order to do a loan. So they would like other options. That's where our non-QM programs come in. So every day as the conventional rates get a little bit crazy, these non-QM programs become even more popular. So for the final demo, we'll do investment property again, ADLTV again, and this time we will select expanded guidelines, also known as non-QM, so we can have a more feasible option for our borrower. Now, when we do non-QM, the first thing we must select is income. And as Kyle mentioned at the start of the show, the most popular option for us here at the Mortgage Calculator, our most popular loan, is our DSCR option for investment properties. That's because it doesn't actually require any income or employment from our borrower. We simply use the estimated rental income from the property to determine a DSCR. It stands for debt service coverage ratio. If the estimated rents can cover the PITIA, the expenses of the mortgage that we're proposing in this case, aka the property cash flows on a monthly basis, that's a ratio of 1 or higher. We also have options for ratios under 1.00 where the property does not quite cash flow on a monthly basis. For our demo, as we do every day, we will put 1.5, which is the highest value, so we can see all the different options pop up. And prepayment penalty is standard on a non-QM investment property. 3 years is the standard. That's what we always use. We can select 0, that will cost more, and we can select 5, that will cost less, but we'll limit our loan programs. So we always choose 3 as the most common, so we can check out the most common options on our pricing here. So best option here at the top for DSCR, 8.125 rate, but our investors are happy here with 0.6 discount points and cost. Very reasonable cost here. As long as the property cash flows, they are happy, and puts our final APR 8.178. So very reasonable APR, almost right in line with conventional. And most investors, when they're presented a conventional option that costs tens of thousands of dollars versus a non-QM DSCR option that is no employment required, no income required, and costs much less, I'd say 90% plus of investors will choose a DSCR option. So definitely the best option we have here. And if we scroll down, there's hundreds of different versions of these. Some of these may allow credit events, foreclosures, bankruptcies, get us around some other things. And very popular requests, some of these may allow short-term rental income, which brings us to our topic for today, which is going to be a deep dive into some of those variations here. Hopefully Jose has a short-term rental income example pulled up. But let me switch my screen and we will go into a farther deep dive here on our DSCR loans. So we always do a quick run through on the live pricing as I just finished up with. But Jose will have some more detailed examples, more of ways to leverage these programs in different scenarios. So Jose, I guess you could run over the basics again and then run us through your examples.
Awesome. Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Today, we're discussing our flagship program, the Debt Service Coverage Ratio Loans. Now, what do we mean by debt service coverage ratio? That was historically only an option that was available for true commercial loans, but we now have a hybrid of that program that is able to be used for residential properties 1 to 4 unit. And we also have it at our disposal for small multifamily properties, 5 to 8 units and up to 10 units as well, without having to go full commercial. Right. So that does present some good benefits, mainly that we don't have to worry about the zip code where the property is located. As you know, if you go the traditional commercial route for your DSCR product, they will be analyzing the zip code for population density and other demographic factors to see if they want to even get involved in that loan or not. On the residential side, that is prohibited by law. So the only thing that may impede your DSCR loan, other than not meeting the debt service coverage ratio percentage guidelines, would be in some cases if the property is considered rural, right? If it's rural, there's going to, in some cases, they don't even do it. And in the cases where they do it, it would have to meet certain additional requirements to be able to fund that loan. So keep an eye out on your rural type properties. So debt service coverage ratio is calculated by dividing the gross rent, the monthly gross rent for the property, divided by the monthly housing expense, PITI. And if a PUD or a condo, you also include the association fee. The best options are with the debt service coverage ratio over 1.0. But as Nick mentioned, we do have options below 1.0 is basically we have 0.75 to 0.99 range where it doesn't cover. And then we have below 0.75, which definitely does not cover. Now, typically, those programs are used more for your trophy properties. The investor knows how to handle that property. They're going to obtain a better income than the market rent would be showing for that property due to maybe using it as a short-term rental, which is a very popular option now for the DSCR program. That is one of our workarounds for when we do have a short-term rental property where there is no long-term lease and where there will never be a long-term lease. As you know, if we go the traditional investment property route, on conventional, that would be a no-go, right? You need to have a long-term lease. If it's a refinance or if it's a purchase, you cannot have short-term rent use. Well, that's not the issue for our non-QM products, and definitely not an issue for our debt service coverage ratio option. Debt service coverage ratio programs never require verification of the borrower's personal income, nor does it require any verification of employment for the borrower, nor is it consider does it consider the DTI of the borrower. It only looks at the debt service coverage ratio of the subject property. So it's a great program for our investors that have multiple properties, 5, 10, 15 properties, and may have a high debt service. Excuse me, may have like a nice Lamborghini with a $5,000 a month payment, but doesn't matter. We're only looking at the debt service coverage ratio of the subject property. So we're going to go over some purchase examples here as we have a lot of investors looking to scoop up properties all over the US, and especially in some of our markets where we have some lower prices compared to good market rents, like, for example, Ohio, Missouri, Pennsylvania, Wisconsin. I mean, those are markets where we're seeing debt service coverage ratios in some cases of like 1.5, 1.6, 1.7. So for those of you that think that there are no opportunities to have the rent cover the housing expense, you need to expand your horizons and your markets and look at other options. In some cases, we're getting, for example, I've done these in for a 2-unit property in Wisconsin with a DSCR of 2.0. So, you're getting $120,000, $130,000 property where each unit is rented for $1,200. You're going to have a very good DSCR. So the maximum DSCR, and this is applicable only for a 1-unit property, please be aware, is 85%. That's our maximum LTV. But we have pretty good rates. The lowest cost option is 10.25%, but you can buy it down all the way to 8.75%. Now, it is a little more costly than the 80% option because, as is usually the case, we have limited offerings at 85%, even though at the mortgage calculator we have them all, but there's just less conduits for this loan to values. And so the pricing is going to be a little less competitive, and it is also going to be more reflective of the higher inherent risk for the portfolio of the secondary market at the higher loan to value. Hence, we have these rates, which you're going to be able to compare now when I show you the 20% down option, right? Because here, if we're going to compare apples to apples, right? 8.375, and this is for a 1 unit property. 8.75 is giving us an $1,100 lender credit. You can buy it down all the way to 7.375. So if you saw the rate, and this is 80%, by the way, folks. So if you saw the rates Nick just posted for an investment property under conventional, this is going to beat it. And this is not going to require any income verification. Now, this is with a 3-year prepay, which the conventional does not have, but most investors will not care about that. And you can better the cost by making it a 5-year prepay instead of a 3-year. But I'm going to go back over a minute now to the 85%, where you can see that 8.375 is not even an option, and it's costing you $13,700. Whereas in the other option, 8.375 is an $1,100 credit. So lower rate and about a $15,000 swing in the cost, right? And if we look over here, this is a $400,000 loan amount. So you're looking at about 3.25 points, right, at the lowest cost option. So, I mean, I really think that 15,004,812 is almost 4 points, the difference, right? 4%. So I really feel that the investor would probably, unless they were going to accept the 10.25% rate, because that's the rate that has the lowest cost, right? And maybe they have that amazing cash flow property and they don't really care and they want to save the money. That's okay. That's a perfectly good example. But if the property is going to have some cash flow issues and you need a little bit lower rate, then it would probably be the best case scenario to go with the 20% down option. But the 15% down option will work for the high cash flowing property where the investor maybe wants to pick up 2 of them instead of 1, and that extra 5% for each property in their own pocket is going to allow them to purchase both properties. That's a different story. But here you see 8.375, right? And you can buy it down all the way to 7.375. So that's amazing. I think that's going to beat conventional investment properties at an 80%, which I think may not even be possible right now. Now, great news. The 2 to 4 unit property, no loan level price adjustment, right? Here we are. We can make it happen for your 2 to 4 unit property at an 80% loan to value. This is not possible on conventional investment full doc. For a 4 unit property, the loan to value on those is lower than 80%. And mind you, this price gets even better if you make it a 5-year prepay instead of a 3-year prepay. So, like Nick requested, we do have short-term rental options. I have 2 different short-term rental options at an 80%. Right here, we're using AirDNA, right? So the rate is a little bit higher to have our option that allows us to use AirDNA without an LTV hit, because that's what you got to be aware of. In some cases, when we do include a short-term rental component on the loan, some of the outlets do hit you with a 5% LTV haircut. So here, we choose the option that doesn't do that 5% LTV haircut. Rate's a little bit higher, but you know you're going to cash flow like crazy when you're using AirDNA. Now, to use AirDNA, it's the AirDNA database, and you have to search for your comps in the same manner that the appraiser is going to search for comps in the MLS database, right? Proximity to the property is very important. Gross living area is very important. The style of the property, the use of the property is very important. All of those same factors that you would use to select suitable comps for long-term rent are the same factors that have to be considered when you're searching for comps in the AirDNA database. Nothing changes. So if your comps are 10 miles away and that's the only one you could find, then it's not going to work. But we're looking at great rates here, 8.99 lowest cost option, and we can buy it down all the way to 7.375. So this is a really good rate sheet. We have another short-term rental option using the short-term rental revenue report. Now, for a purchase, if the seller is currently using the property as a short-term rental, the seller should be able to provide the revenue report for the last 12 months for the property. I recently sold one where the seller provided the short-term rental revenue reports to the appraiser, and the appraiser was able to use that to calculate the short-term rental income for the property, and the property was able to be successfully sold. So you need a little cooperation from the seller there on the purchases. But again, you'll note that the rate is a little bit lower than using AirDNA, but a little bit higher than using just the long-term rent. But again, in this case, no LTV adjustment to use short-term rental income. So we do have a great 8.5% rate with an $1,100 lender credit. And again, you can buy that down to 7.375. So very good option, DSCRs for your short-term rental. Now we have the additional mind blower, right? Closing on the property that is not cash flowing at a 1-to-1 ratio, right? So here we have our 0.75 to 0.99 up to an 80% LTV. This is a very good option and very good rates as well, considering this property is not cash flowing at a 1-to-1 ratio. So you're looking at 9.625 with a $600 lender credit. And you're looking at 8.125 as your lowest rate option. And the real mind blower, the DSCR that is cash flowing at less than a 0.75 DSCR. So that could be a 0.1 DSCR. I mean, I don't know of any property that would be that unless it's like the amazing waterfront trophy property that's going to be a short-term rental at $10,000 a night. But as a long-term rental, it's maybe $10,000 a month, right? And it's maybe a $2 million property. That's not going to be a 1.0 or more DSCR, but the investor's confident that they're going to be able to do it. They've already done it before. So here you go, 75% LTV, 25% down payment, and look at those rates. Once you drop down to 75% LTV on these no ratio options, the rate gets phenomenal because you're looking at 9.25 with a $563 lender credit. And you're looking at 7.99 as your lowest rate option. Keep in mind, this is with a 3-year prepay. If you add a 5-year prepay to this, your cost drops by half a point. So in that case, you would be looking at about, let me look at my loan amount here. You're looking at 375. So you'd be looking at around 8.875 being your par rate if you had a 5-year prepay. So just imagine that, less than 0.75 DSCR, and you're at an 8.875 at par. So amazing product. I don't have any refi quotes for you here, but I will state that we do have maximum 80% DSCR cash out is available. Is a little costly, but we can do the maximum 80% LTV on a 1 unit property, and we can go 75% DSCR cash out as your standard option. So 80% now we do have at the mortgage calculator for your DSCR cash outs.
All right, no questions here.
Yeah, I don't see any questions. All right. Well, to navigate you through these type of loans, this is our specialty here. So you can visit us at themortgagecalculator.com. We have over 350 loan officers that can navigate you through these programs. We do this show at 11 a.m. Eastern every single weekday where we go through the live rates and do a deep dive into a different topic. So we'll be right back here Monday at 11 a.m. Eastern with a different topic. So thank you, everybody, for tuning in. Thank you, Nick. Thank you, Jose. And we look forward to seeing you Monday, 11 a.m. Eastern for the next episode of Daily Rates Live with the Mortgage Calculator. Everybody, take care. Have a nice day.
Thanks, everybody.
Thank you, everybody. Have a great day.